This podcast is intended for investment professionals only. All investing involves risk.
Hello and welcome to Market Talk, where today we'll be discussing the market reaction to events in France and South Korea, expectations ahead of the Fed's final rate decision of the year, and whether 2025 will prove a turning point for China's economy. I'm Harry Brooks, and today I'm joined by Ben Bennett, Head of Investment Strategy for Asia, who joins us from Hong Kong. Welcome back to Market Talk, Ben. It's our last one of the year, and it feels like we've got plenty to talk about before dashing off to the late night garage to stock up on Christmas presents.
No, I'm boycotting Christmas presents this year. I think the one I bought last year for my wife was taken back to the shop, so that's me done for Christmas presents. But I am looking forward to our Christmas team lunch on Friday. That's the main thing in the diary.
Excellent priorities. So let's start by recapping the two big political dramas of this past week. A week ago today, French Prime Minister resigned after a no confidence vote toppled his minority government, and that was after a standoff over his plan to save 60 billion euros through spending cuts and tax rises in the hopes of reducing the country's deficit. Where do we go from here? What happens next?
Well, the tricky thing is that he didn't have a majority in the government, in the parliament. So do you remember back in June, there was all this hoo-ha when the president, Macron, called a snap election, trying to get some clarity and some support for his policies. And it backfired miserably because he didn't get the support that he wanted. His party lost majority. He still had the ability to put in a prime minister, which is Barnier. But, when it comes to unpopular stuff or stuff that maybe doesn't quite fit in with the other parties, it didn't work. So the budget, in effect, was rejected. No confidence vote. Barnier has to leave. And the problem going forward is that you can't have an election, a parliamentary election in France within a year of the last one. And the last one, like I said, was back in the summer, wasn't it? The end of June. So we've got to wait another few months before you could have another election. So this is going to continue, this issue. I think Macron isn't resigning. That's what he said. He'll have to try and appoint a new prime minister, but they'll have exactly the same problem, trying to get a budget through. Now, and we've had these budgetary problems before, haven't we, in the US? And we've all been quite worried about that because if you don't have a budget in the US and it goes through certain time, then they stop being able to pay money to people, actually pay the bills. That's not the case in France. They can continue to pay bills, and it's a bit more complicated than that, but we're not talking about a hard stop. So it's not actually the end of the world. It's just a little bit awkward.
How did markets react to all this? I remember back in the summer, we saw that big widening in French government bond yields amid concerns about the country's rising debt load. Has this latest development worsened those fears? And are there any big events on the horizon that could bring the deficit issue to a head?
Yeah, you're right. So we look at the difference in yield between French government bonds, the 10-year government bond, the yield of the French government bond versus the German government bond, because the German bond yield is sort of the benchmark in Europe. So that difference spiked up when Macron called the election in the summer. It settled down a little bit, and then just more recently, it's been going higher again. So as of the 2nd of December, so this is a week and a bit ago, we got up to 88 basis points, so nearly 1% in terms of yield difference between that 10-year French government bond and the German one, which is a fair amount when you're only talking about 2 and a bit percent for the German government bond yield. So it's a chunky amount. And you've got to go all the way back to 2012 for it to be higher than that 88 basis points. You remember 2012, that's when Greece was going, had all their difficulties, the euro crisis, peripheral crisis. Back in 2012, the French spread did peak nearer 200 basis points. So we're only halfway there, actually. And the other thing that, like I just mentioned, I don't think this is a sort of existential threat to the euro. If Macron resigned and they had a presidential election and a sort of very extreme party was elected that started talking about leaving the euro, yes, of course, then you can start to think about really big issues for France. But as it currently stands, with Macron not resigning, you're just in a bit of limbo as opposed to something that is actually could lead to really wide spreads. So what happened is that 88 basis points on the 2nd of December, even though since then we've had the collapse of the no confidence vote and the prime minister's had to leave, that spread has actually come in a bit. It's almost as if people hedged, got a bit worried before the event, and as the event has unfolded and maybe the extreme scenarios haven't happened yet, then that spread has been coming in, and we've been trading it that way as well. We've been looking at that as an opportunity as the yield was going up to actually add a little bit of French risk at those sorts of levels.
Okay, well, if all of that wasn't enough for 1 week, last week we also saw the imposition of martial law in South Korea, although in the end, I think it only lasted for a few hours. What led to this situation, and how did markets react to what went on there?
I think it's trouble following me around. I flew to South Korea on the day, and I landed, and about an hour later, the President Yoon had declared martial law, which, as someone, I'm not obviously not South Korean, and I didn't know what that meant. But talking to people on the ground in Seoul, there was a lot of confusion. I wasn't the only one that was confused. And you have to go back a few decades before the last time that was declared. The underlying, as it was explained to me by people in Seoul, is that the president is under a lot of pressure domestically, some of policies. And it's almost the same similar backdrop as in France, that the president in both countries doesn't have the parliament majority backing them. So President Yoon was finding it very difficult putting through some of his policies in government, and took this very dramatic, incredibly dramatic step of calling martial law. But the parliament came in and decided, no, that's not what we're going to do. And President Yoon had to backtrack quite quickly. And it has settled down a bit. So an awful lot of noise, but I think the headlines were a bit scarier than the underlying, but still quite a lot of confusion, as I said.
You mentioned in one of your presentations internally earlier this week that the country's equity markets are a bit of an outlier, as one of the few tech dominated markets not to have delivered big gains this year, instead, at least at the time of recording, declining year to date. What might it take for South Korean tech stocks to make up that gap with their counterparts elsewhere in the world?
Yeah, so the Kospi is the name of the South Korean stock market, and that index, as of taping, so let's actually take the 9th of December, that's Monday's close, that's down 10% year to date, tech dominated, as you mentioned. Let's compare that to other tech dominated stock exchanges like the Taiwanese Stock Exchange or NASDAQ in the US. They're up 30% or so. It's been a great year for tech. We know that, don't we? And if you look at how expensive these indices are, the Kospi is trading at about 10 times earnings. So you've got to pay roughly 10 times the price of earnings. Taiwan, it's 20 times, or NASDAQ 30 times. So people are prepared to pay a lot more for other stock markets. So what's going on here? Well, I mean, of course, some of it is political uncertainty, perhaps weighing on this, but also a lot of these indices have got some very large stocks that represent a significant amount. And we know in South Korea, I think we can all name at least one very large technology company in South Korea, makes a lot of phones. And you've got to then dig into the valuations of single names. That's not my expertise. I wouldn't want to comment on that. So that's something you've got to get comfortable with. But, if you do think that momentum is going to turn around and maybe change at some point, or you just like value indices, and like I said, the Kospi is trading at relatively low earnings multiples, then that's one thing to keep an eye on. It is an interesting outlier.
Let's turn now to the US, and looking at US government bond yields, we saw a big fall in yields in the lead up to that first rate cut in September, and expectations that there would be more to come. Yields then rose after Trump won the election as markets anticipated pro growth and potentially inflationary policymaking. I see that recently yields seem to be heading back down again. Is there a feeling that some of those Trump trades may have been overplayed?
Yeah, I think so. I think that's a fair point. And overplayed, I mean, it's just obviously investors, markets can go and overshoot and then come back again and correct. The initial reaction to Donald Trump winning the election and the Republicans winning both the House and the Senate was pretty straightforward: higher dollar, higher government bond yields, and stronger US equity. So this is, we're going to be talking about more spending by the US government, potentially tariffs. This is all higher yields, higher dollar, maybe tax cuts, deregulation. That's all good for equities. But I do think as the dust settles and Donald Trump has been nominating parts of his government, you've seen a more nuanced reaction. So you've seen a few more winners and losers within sectors, within names. And you've also, I think, just started to see some of those very straightforward trades, like the higher yields, starting to come off a bit. And we've got a few weeks now. Of course, we've got the holiday season, so that's going to be a bit quieter anyway. But we're waiting until the 20th of January, which is when Donald Trump is going to have his presidential inauguration. So until that point, maybe we're going to have less information. So some of those obvious trades have just settled down. But I suspect after the 20th of January, we're going to be pretty busy, aren't we? We're going to have a lot of headlines, going to have a lot of activity, and we'll probably have a lot more volatility in markets.
So the Fed meets on Wednesday, and I gather 25 basis points is the expectation for how much they'll cut by. What do you think the chances are of anything happening over between now and then that could lead to a surprise move?
Yeah, that's right. So we're taping this on Tuesday, the 10th of December. So the Fed is meeting on the 18th. Well, they'll be announcing policy on the 18th. But tomorrow, which is the 11th of December, which I guess we'll know by the time people listen to this, but I guess the last big piece of information that the Fed will consider is being announced, and that's US inflation, CPI. I think it would have to be quite a big shock either way, and more likely to the upside, I'd say, for the Fed to not cut by 25 basis points. There is a small chance that they decide to pause and decide to keep rates on hold. But like I said, probably that would take inflation. Core CPI in the US is running at about 3.3%. Now, everyone's hoping, the Fed's hoping that goes down over the next few months, maybe back towards 2.5% or so. So it'd be nice to see that stay at 3.3 or go lower. If it jumped to 3.6, 3.7, then then we're talking about the Fed having to maybe pause one rate move. But that's the only bit of information. Everything else recently has been pretty much in line with being able to cut. We saw US employment, for example, last Friday. That was a big, important announcement, and we saw a report roughly in line, allowing them to be able to cut. We saw unemployment rise a little bit, for example, which gives them an excuse to cut interest rates. If you see unemployment rising, maybe you'll be able to cut interest rates. That'll be in their mind.
Looking at my calendar, I can see that the European Central Bank is meeting on Thursday, the same day this podcast comes out. What will be top of mind for Europe's central bankers as they head into that meeting, and what are the markets expecting them to do?
Well, the base case is exactly the same as the Fed, a 25 basis point cut, but it's the other way around in terms of the risk. So the Fed, if they see some strong data, they might not cut at all. The ECB has seen some weaker data recently, and there has been some pricing in markets, some possibility of a bigger cut, so a 50 basis point cut being priced into markets. But I'd say that would still be a surprise. 25 basis points is the most likely, so I'd be prepared to look really stupid on Thursday as soon as this comes out. We've had some soft sentiment data. PMI sentiment indicators out of Europe have been weak. We've also seen some relatively weak German actual sort of hard data too. So that's the reason why they could do 50 basis points. But elsewhere, there's been a reasonable amount of strength certainly in the hard data. France is doing fine. Spain's doing very well. Italy's doing fine. So that's the reason why they probably just do a 25 basis point cut.
Inflation dynamics are very different in China, of course. I think core annual inflation there is running at something like a tenth the level that we're seeing in Europe, hovering just above zero. Earlier this week, yesterday on Monday, some of the country's leaders said they were changing their monetary policy stance from prudent to moderately loose, which is reported, from what I saw, as being the first time that had happened in 14 years. And this is ahead of an annual meeting later this month. This led to a bit of a rally, stoking hopes that policy makers might get serious about tackling weaker economic growth. Did you see anything new here? It feels like there's a lot of interpretation going on of what was said, but less in the way of concrete detail.
Yeah, I read a report which I quite liked saying that the Chinese policymakers are long on talk and short on
Yep.
action recently. And that's been the case for a few months. We have heard all this very supportive rhetoric, which has fed into some degree of better activity data. We've seen some stronger activity in the housing market. The consumer's starting to spend a little bit more money, but it's coming off a pretty low base. As you say, the Politburo came out earlier this week and said, yeah, we're going to move monetary policy to moderately loose. I mean, interest rates in China, the 10-year government bond yield is below 2%. I mean, it's very low yield. And there's a lot of liquidity around. So I'd say monetary policy is pretty loose, but that doesn't really help when you've got a balance sheet issue. There's a lot of bad debt in China. People just don't want to borrow. So it doesn't really matter how low government bond yields, how easy monetary policy is. That the issue is that the assets that are sitting there, the houses, are not, well, they've gone down in value, and people are a little bit worried about that. And there is this big meeting. It's called the Central Economic Work Conference, which happens every year, and they set next year's growth target during this meeting. We won't hear what it is yet. We'll have to wait till March for them to announce what they've decided, but they will set it. They could come out with some more measures, more fiscal easing, perhaps. I just don't think it's so far that the actual actions have been enough. I think the problem, as I mentioned, is a balance sheet issue. It's not necessarily about monetary policy, and the problem is very big. If they really wanted to reinflate the Chinese debt issue, it's take a huge amount of cash. And the third point is, I just don't think they want to do that. I think they still want to just shift from an overinvestment economy into investing in new productivity areas, technology, all that sort of stuff. So, yeah, I'm not a believer that this is a big shift, to be honest.
It's reached that part of the podcast again. Ben, what's your number of the week?
Well, I'm choosing 8%,
Okay.
and I'll tell you why in a second. But the backdrop is that we're sort of coming to the start of the new year, and you're going to see an awful lot of people like me telling investors, telling banks, companies, what they think about next year's growth forecast, inflation forecast for next year. Now, 8% is basically the accuracy of the best forecasters. So we've taken the IMF, who have got 1,000 economists, $100 million per annum budget on macro financial forecasting. And they produced an analysis of their accuracy, and we extended it from 1992 to 2022, had a look at their accuracy at predicting a recession a year before it happened. And like I said, they got about 8% correct. So I would take forecasts from people like me, particularly about growth, inflation, which is really, really, really hard to forecast. I take that with a pinch of salt. And I'd also say that the one thing that I try and think about when it comes to investing and markets is that it's sometimes better to look at when confidence is really high in a certain outcome and just question that, and maybe just think that's maybe not the best thing to be buying. Maybe even you should be selling it or buying something else. So beware when confidence is high. You really shouldn't be confident about anything to do with economics, and certainly not growth and inflation, if the best can only get 8% correct.
That's definitely some food for thought. 8% accuracy from 1,000 economists isn't super impressive, is it? Well, have a wonderful Christmas, Ben, and thank you to our listeners at home. We'll be back for more market talk in 2025.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal and General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market, or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal & General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal & General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal & General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.